Okay, in the previous video, in the previous video, very long video, we have looked at adjusting entry in the case of deferrals. Okay, we have looked at under deferrals there are two major types, which is the prepaid expenses and unearned revenue. Okay, so now we will look into the other type, the other major type of adjusting entry, which is the accruals. Okay, so accruals is revenue for services performed but not yet recorded at the statement date. Okay, we do adjustment for accruals when we have revenue but we have not recorded. Okay, we have not recorded the revenue, as well as we do adjustment for accruals when expenses, we have incurred the expenses but we have not yet paid and we have not recorded the expense at the statement date. Okay, right. So what do we mean by accrued revenues? Revenues for services performed but not yet received in cash or recorded. Okay, we go to the first type of accruals first, which is the accrued revenues. Revenues for services performed but not yet received in cash or recorded. We have done the service. We have rendered the service, or we have sent out our items to our customer, but we have not yet received the payment from our customer. Okay, so revenue is recorded but before cash received. So adjusting entry shows the receivable that exists and records the revenues for services performed. Okay, when we have conducted our revenue, we should consider it as an asset, because we are expecting to get benefit from what we have done, and then we should also record the revenue. We should record it as a revenue because we have done the service. Okay, so for that reason, the adjusting entry is we need to increase an asset account. Okay, because we have done the service, therefore we are expecting future benefit, therefore we debit our asset account. And we should also increase our revenue account because we want to recognize that we have done some work, and therefore we have some revenue or income from that work. Okay, so the adjusting entry is we debit our asset and we credit our revenue. Okay, so for example, in the illustration here, in October, Pioneer Advertising performed services worth $200 that were not billed to clients on or before 31st October. In October, Pioneer Advertising has done some work worth $200, but then Pioneer has not billed to clients, have not sent an invoice to the clients at the end of October. Therefore, we need to do adjustment. Right now, as it is, on October 31st, there's no recording whatsoever in the accounts regarding the revenue. Therefore, to do the adjustment, we need to recognize this. Okay, so first we need to record an asset. Okay, because we have Pioneer Advertising has done the work, therefore they are expecting to get benefit, which is cash. They are expected to get benefit of $200, so that is an asset. That asset is called accounts receivable. Okay, when we have done our service and we have not received payment from our client, that is an asset called accounts receivable. So we debit accounts receivable $200, and we debit service revenue, because when we have done the work, then this is a revenue for us. We should recognize this as a revenue. It will increase the owner's equity. Therefore, we record this as credit to our service revenue as $200. So let's for example, let's say on October 10, Pioneer receives cash. Okay, from this revenue service, Pioneer actually received cash later on for the service performed. Therefore, on October 10, we receive cash, therefore very easily we debit cash $200. But then because we have received cash for the service rendered, and we no longer expect to get $200 because we have already got it before, therefore we need to reduce our accounts receivable. How to reduce accounts receivable? We need to credit our accounts receivable by $200. Now our accounts receivable is no longer there. Okay, we originally had $200, but now we credit it to $100. Therefore, no longer our client is owing us for the service that we have rendered. Okay, to do the analysis, let's see. The asset accounts receivable is increased by 200. Okay, when at the time when we render our service, our assets receivable should be increased to $200 because we are expecting to get future benefit, and the revenue service is increased by 200 because we recognize that we have done a revenue service. And the effect of that in the accounting equation is that we are expecting to get benefit, therefore our asset increases by 200 because we are expecting to get future benefit, and our service revenue is increased as well because we recognize that we have done some work that is a form of revenue. In terms of the debit and credit analysis, because we want to increase our accounts receivable, therefore we debit our asset, increase accounts receivable. And because we want to increase our service revenue, therefore we credit our service revenue. And then we do this, after doing the debit credit analysis, we put it into our journal entry. So on October 31st, we debit the accounts receivable and we credit our service revenue 200. And after doing the journal entry, we post to the accounts. Therefore, we will see in our accounts receivable, we have an adjustment of $200, which increases our accounts receivable, and on our service revenue we have a credit of 200, which increases our service revenue. As a summary for the accrued revenue, okay, examples of accrued revenue includes interest, rent, and services. And the reason for the adjustment is that we have done the service, but we have not received the cash, or we have not recorded the service, because by the end of the month we still have not sent out invoice to our customer, even though we have done the service or we have sent out the item. Okay, therefore, before the adjustment has been done, before we do the adjustment, then the assets are understated. Okay, why is it understated? Because we have not done any recording. We should receive cash in the future, but it is not recorded. Therefore, our asset is not showing the full picture. So our asset is understated. And our revenue is also understated because we have not recognized the revenue. Therefore, our revenue is lower than it is supposed to be. So our revenue is understated. To adjust this inaccuracy, therefore we need to debit our asset to increase back our asset, and we need to credit our revenue, which is to increase back our revenue. Okay, so that is one category of accruals. The other category of accrual is accrued expense. We have looked at accrued revenue. We have done the service, but we have not received the money. But now we look at accrued expenses. We have incurred the expense, but we have not paid the money. Okay. Examples include rent. We have stayed at the place, but we have not paid the rent. We have made the borrowing, but we have not paid the interest for that period. We have incurred taxes from the government, but we have not paid the taxes. Our salary, our workers have worked for the month, but we have not paid the salary. So that is we have incurred the expenses, but we have not paid the money. Okay, so in accrued expenses, we do the adjusting entry because we want to record the obligation. We want to recognize that we have an obligation to to the other party. Okay, so an obligation, or in other words, the liability. We want to record the liability, and we want to recognize the expense because we have actually incurred the expense, but we have not do any recording. Therefore, we need to do the adjustment. So the adjustment will be an increase in the expense account, because we want to recognize the expense that we have incurred. Therefore, we need to increase the expense account by debiting the expense account. And on the other hand, we need to recognize that we have an obligation. We have some money owing to other party. Therefore, it is a liability. We want to increase our liability. Therefore, to increase the liability, we need to credit our liability account. Okay, we debit our expense account and we credit our liability account. That's the adjusting entry for accrued expenses. Okay, so for example, Pioneer Advertising signed a 3-month note payable. Note payable is some sort of a loan. Okay, and a loan to receive money, to have some cash. Pioneer signed a loan, which is called a note payable, 3 months. So Pioneer Advertising should be paying back the note payable within 3 months. Okay, and the amount is 5,000. So Pioneer Advertising is borrowing 5,000 from October 1. The note requires Pioneer to pay interest at an annual rate of 12%. So the interest rate is 12%. So Pioneer Advertising should be paying for the interest. Okay, should be paying for the interest. How much will the interest be at the end of October 31st? Okay, because the borrowing is 3 months. Therefore, there should be an interest, a 3 months interest. But the annual rate, the interest rate for 12 months is 12%. Therefore, one month is 1 over 12. Okay. Therefore, the borrowing is 5,000. The interest rate is 12%. Therefore, the interest that should be paid is 12% out of 5,000. But then only 1 month has passed. Therefore, only 1 month of interest is due. Therefore, it will be 1 over 12. So the interest will be 5,000 accrued at the end of October 31st. Therefore, to make the adjustment, we debit interest expense by 50, and we credit interest payable. Interest payable is a liability account because we owe interest. Okay, Pioneer Advertising owes interest for $50. Therefore, we credit interest payable liability account by $50. Okay, an analysis of the transaction is that the interest expense is increased by 50. Okay, the interest expense account is increased by 50 because now Pioneer is owing interest for 1 month, which is $50, and the liability interest payable is increased $50, showing that now the company owes to pay $50 for that month. Okay, liquidation analysis, we want to increase our interest payable. Therefore, we add to our liability. Okay, and because it is an expense, therefore an expense will reduce owner's equity. Therefore, it has the effect of negating by $50. Okay, negative $50. Debit credit analysis. Because we increase our interest expense, therefore we need to debit it. And because we want to increase our interest payable liability account, therefore we credit our interest payable liability account. The journal entry therefore will be on October 31st. We debit interest expense by 50 and we credit interest payable by 50 as well. And after doing the journal entry for the adjustment, we post to the accounts. Firstly, we post to the interest expense account for $50 debit, and which brings the balance of 50. and then we have the interest payable. Credit our interest payable for $50. Okay. Alright. Next example of an accrued expense is accrued interest. Okay. Well, okay. It's not accrued expense, interest. This is accrued expense in terms of salary. Okay, there's an error in the title here. Okay, this is salary. Okay, so Pioneer Advertising paid salaries and wages on October 26. The next payment of salaries will only incur until will not incur until November 9. The employers receive total salary of 2,000 for a 5-day work week or 400 per day. Okay. Right. So the employees work for 2 weeks. Okay, from 15 of October until 26th of October. That is 2 weeks of pay, or 2 weeks of pay, 2 times 5-day work. Okay, so Monday, Tuesday, Wednesday, Thursday, Friday. That's 1 5-day work week. And then from 22nd, 23rd, 24th, 25th, and 26th October, that's the second 5-day work week. Okay, so 2 times. Okay, so employee is receiving 400 per day. So they should be receiving $2,000 for 1 week. Okay. Right. So let's see here. Okay. So, but Pioneer Advertising is only paying on November 9th. Okay. So, let's see here. Okay. So the work done between 15 and 26, at the end of these 2 weeks of work, Pioneer pays salary on 26. But then afterwards, at the end of October, Pioneer the workers pay work from 29. The workers work on 29th, 30th, and 31st of October. There are 3 days in October that the employers have done their work, have come to work, but then Pioneer is only paying them on 9th of November. Therefore, there are 3 days in October that people have worked but no salary has been paid. Therefore, there's a 3-day adjustment needs to be done. From 15 to 26, no problem, because Pioneer has already paid on 26, which may not have been said here, but that is what is illustrated in this calendar. Okay, from 15 until 26 October has been done and has been paid, because it shows here that payday is 26. But next payday is 9th of November. Therefore, 3 days of work on October has not been recognized. Okay, so there needs to be adjustment for that. So, right. Okay, so the 3 days, if you see back here, one day of work is $400. Therefore, 3 days in October has not been paid. Therefore, 3 days times $400 per day is $1,200. Pioneer Advertising has not paid salary for $1,000. $1,200 is owed by Pioneer Advertising to its employees. Therefore, the expense, salaries and wages expense is increased by $1,200. Therefore, we need to increase the wages expense by $1,200, and we need to also increase the liability by $1,200, because now Pioneer is owing the employees by $1,200. So we need to increase the liability account of which is called salaries and wages payable. So the expense account is called salaries and wages expense account. we increase it by 1,200, and we also increase the liability account, which is called salaries and wages payable. Okay, so the equation analysis is that because we increase salaries and wages payable, we increased our liability, and because our expense also increase, therefore we need to add to the salaries and wages expense. But because salaries and wages expense is will reduce our owner's equity, therefore the effect is a reduction of 1,200 on owner's equity side. Therefore we have a net of 0 changes. Okay, and then we look at the debit and credit analysis. Because we increase our salaries and wages expenses, because it's an expense account, we need to debit the expense account. And because we want to increase our liability, therefore we credit our liability account. We credit our salaries and wages payable by 1,200. So the journal entry will be on October 31st, salaries and wages expense will be debited to 1,200, and our salaries and wages payable account will be credited by 1,200, and this will have effect on the accounts. After doing the journal entry, we will post to the accounts, and this is the effect on the accounts. On salaries and wages expense, on 31st October, there's adjustment of 1,200. Therefore, the balance of salaries and wages expense is 5,200. And on our salaries and wages payable account, we have an adjustment of 1,200 on the credit side. Okay, which brings the balance. At the end of October, the company is owing 1,200 to pay salaries and wages. So as a summary of the accrued expense, examples of accrued expense would be interest, rent, and salaries. The reason for the adjustment is because we have done the expenses, we have incurred the expenses, but we have not paid in cash, and we have not recorded the expense. Okay, so at the time when we have not done the adjustment, the expenses will be understated because we have not taken into account the expenses that we have done that we have not paid. And then we have also understated our liability because we actually have something, somebody to pay, but we have not paid it. Therefore our liabilities is not showing the true picture. Our liability is understated. So to do the adjustment on this inaccuracies, we need to debit our expense in order to increase it, and we credit our liabilities in order to reduce it.